I'm Michael Dalto with Griffin Hammis Associates, and this is Self-Employment and Benefits from Social Security. I have a daughter. When she was 5 years old, one day she went with her mother to the supermarket, and it was one of those extremely busy holiday weekends when everybody's in the store. And her mother said to her, "Oh, Nora, I get agoraphobic in places like this." And my 5-year-old didn't know what that meant. She just knew that her mother was in some sort of distress. For those of you who don't recall your psychiatric diagnoses, agoraphobia is fear of being in public places. But my daughter wanted to commiserate with her mother. So she just said to her, "Yeah, mommy, I get agoraphobic too. And if I can find it, I also get ice cream." My daughter's taught me a lot about making lemonade out of lemons. In this case, the lemon is we have a very complex system of public benefits that frightens people who are contemplating employment or self-employment. The lemonade is that there are some very, very helpful rules, safety nets known as work incentives that help protect benefits when people work and ensure that they come out ahead through employment or self-employment. And even better, people can get free assistance navigating these work incentives and understanding how they will affect their benefits and net incomes. So self-employment obviously differs significantly from wage employment. It doesn't involve a long-term employer-employee relationship. And generally, you know, if you're self-employed, if you don't receive W-2 forms at the end of the year, you get a 1099 instead. And if you don't have an employer withholding taxes from your pay. Now, self-employment can be traditional business ownership, or it can be something less formal, like independent contracting or gig work. As far as Social Security benefits are concerned, those are all treated the same way as self-employment, distinguished from wage employment. So some of the key differences are that because self-employed people don't have an employer taking money out of their pay for taxes, they have to pay their own taxes. They have to pay federal, state income taxes if there's an income tax, a state income tax in their state, Social Security and Medicare taxes as well. If a person gets net self-employment earnings of over $400 a year, they need to file a tax return with the IRS and pay those taxes. Now, I should note that most of the content that we're going to be covering in this session relates to people who are considered sole proprietors or independent contractors or gig workers. There may be some differences if people organize their businesses as LLCs, limited liability companies, S corporations, or C corporations. So how do self-employed workers pay their own taxes? They do it generally by paying estimated tax, and there are 4 times a year when they're supposed to pay those: April, June, September, and January generally. However, suppose a person misses those deadlines and the end of the year rolls around, they haven't paid any estimated taxes. They will still not be penalized by the IRS if they pay at least 90% of the taxes that they'll owe for the year by the January estimated tax deadline, which is in the middle of January. So if they've missed those other 3 more or less quarterly estimated tax payments, they can still make up for it without penalty by paying at least 90% of their total tax liability in January. And the estimated tax forms can be found at the link on this slide, along with instructions for completing them. So what if people are just baffled about filing taxes? Maybe they've never done it or they need assistance with it. In many cases, they can get free assistance, free tax preparation through a program known as VITA. That stands for Volunteer Income Tax Assistance. It's a program of the IRS. The IRS trains and certifies tax preparers who work for organizations, mostly nonprofits, faith-based organizations, etc. And people can receive free assistance through a VITA program if their household income is less than $57,000 a year. Now, some of the VITA sites will assist with estimated taxes. And to find a nearby VITA site, a person can either call 800-906-9887 or use the online VITA site locator at the link on this slide. So some other differences are that self-employed workers have to pay more tax, specifically more Social Security and Medicare tax. And here's why. If you're a wage employee and you have an employer taking money out of your pay to pay for taxes, the employer will take out of your pay 7.65% to pay for Social Security and Medicare taxes. But behind the scenes, the employer will pay another 7.65%. They'll match that. Now, if you're self-employed, you don't have an employer taking money out of your pay or paying half of your Social Security and Medicare taxes, you have to pay the full amount yourself, which totals 15.3%. So you as a self-employed person are paying essentially double the Social Security and Medicare tax that you would if you were a wage employee. Now, the good news here is that self-employed workers can get help managing their SSDI and SSI benefits when they work by calling the Ticket to Work helpline at 866-968-7842. And if they're receiving Social Security Disability Insurance, SSDI, or Supplemental Security Income, SSI benefits, and they're between the ages of 14 and 65, and they're either working or actively pursuing work, then they should be connected with a WIPA project. WIPA stands for Work Incentives, Planning, and Assistance, that will give them free benefits planning. And this is really essential for self-employed people who get benefits from Social Security, because there are special rules that apply to self-employed workers that either don't apply or apply differently to wage employees. And those rules are not generally as widely known as the rules about how wage employment affects benefits. So a WIPA project can provide expert assistance in navigating the realm of Social Security, disability, and SSI benefits and other public benefits people receive, and help people use the work incentives, the safety nets that help make sure they get ahead and can keep the essential benefits they need. Now, when a self-employed worker who gets SSDI or SSI starts work, they should always report their earnings to Social Security. Now, of course, initially, they really won't know how much their earnings will be. They'll need to simply report that they are beginning self-employment and provide an estimate of what they think their net earnings from self-employment will be for the remainder of the year. So they can make the initial report either by calling their local Social Security office or the national toll-free number, which is 800-772-1213. They can mail a letter to their local Social Security office, or when we're not in a pandemic and the Social Security offices are open for regular business, they could visit their office and report in person. So they need to report that they're beginning self-employment, give an estimate of what their net earnings will be for the calendar year. And Social Security will use that estimate to determine the impact, if any, on the person's SSDI or SSI benefits. Now, suppose a person makes an initial estimate of their net earnings from self-employment for the calendar year, and as the year progresses, they discover that their actual earnings are significantly different from their original estimate. Well, then they can simply contact their local Social Security office to revise that estimate. And that can help prevent them from being either overpaid, meaning they receive more benefits than they should, in which case they end up owing money back to Social Security, or underpaid, meaning that their benefits would be reduced or stopped when in fact they should continue or continue at higher levels. And then a person would not receive enough in benefits and Social Security would end up owing them money. Now, at the beginning of each calendar year, a self-employed person should again provide an estimate to Social Security of what their net earnings will be for the coming calendar year. And again, that's just an estimate, and they can and should revise that if the estimate turns out to be significantly different from the reality of their earnings later in the year. So, how does Social Security evaluate self-employment earnings? Well, to begin with, they start with something called net earnings from self-employment, or NESE, N-E-S-E for short. This is the dollar amount that Social Security begins with when they evaluate the impact of self-employment income on SSDI and or SSI benefits. So to figure out NESE, net earnings from self-employment, you take the person's gross revenue for their business, the total income they receive for the business, then you subtract the business expenses that they pay for, and the IRS has specific rules on which kinds of expenses are allowed to be deducted as business expenses. Take the difference is known as net profit, and then multiply that difference, that net profit, by 0.9235. And that may sound like kind of a weird and maybe arbitrary number, but there actually is a logic to it. By multiplying the net profit by 0.9235, that's essentially subtracting 7.65% from the net profit. And that 7.65% is a deduction for the extra Social Security and Medicare tax that a self-employed person has to pay compared to a wage employee. So it's as if you're getting an extra business expense deduction because of that extra 7.65% in taxes that you have to pay. So after multiplying by 0.9235, the result is known as net earnings from self-employment. And that's the dollar amount that Social Security will begin with when they evaluate the impact of self-employment on SSDI or SSI. And it's very important to note that there is a persistent myth about what Social Security counts for self-employment earnings. A lot of people think that if they just leave money in their business and just take out a certain amount for themselves, which is typically known as the owner's draw, that only the owner's draw, the amount that they took out for their own use, will be counted by Social Security against their SSDI or SSI benefits. And that is absolutely false. Not at all true. Social Security counts the net earnings from self-employment, the NESI, even if the person leaves all of the net earnings in the business and doesn't withdraw any for their personal use. So because business expenses are deducted from self-employment income, it's important for self-employed people to track their business expenses. That will reduce the amount of self-employment income that will count against their benefits. Now, people can track those expenses any way they like. They can do it on paper, they can do it with a spreadsheet, they can do it with an app. And there are some apps that are particularly useful for tracking mileage. Many self-employed people, including a lot of gig workers who work for DoorDash or Uber or Lyft, have major business expenses for vehicle mileage for work. And they can use mileage tracking apps that can be found at the link on this slide. And they can deduct as a business expense work-related mileage other than commuting to and from the workplace. They can use that as a business expense by multiplying the miles that they drove for work, other than their commute, by the IRS mileage rate. In 2021, that's 56 cents a mile. In 2020, it was 57.5 cents a mile. So it actually went down. So vehicle mileage for work other than the commute is an example of an allowable business expense. And that's a very common one for many self-employed people, particularly gig workers. Supplies for the business, the cost of goods sold, equipment, telecommunications, accounting fees, and many others. So before we go into the impact of self-employment earnings on SSDI and then on SSI, I want to reinforce one point. There are many workers who are self-employed but don't know it. Many gig workers, again, who work for places like DoorDash or Uber, may not think of themselves as being self-employed or having their own businesses. But in fact, under IRS and Social Security rules, they are in fact self-employed. And all of the self-employment rules will apply to them. That's also true for private contractors. A worker may think of themselves as an employee because they may be working for a single company, working for an employer. But if taxes are not being taken out of their pay by the employer, they don't have a regular employer-employee relationship, then they'll be considered a private contractor and they will be self-employed. Again, they have to pay their own taxes and their earnings are considered self-employment earnings rather than wages. So once you've established that a person is self-employed, including a gig worker or a private contractor, then how does Social Security evaluate their earnings for SSDI purposes? Well, again, they start with NESI, net earnings from self-employment, and then they allow three kinds of deductions from the net earnings from self-employment when figuring out how much of the earnings they'll actually count against the person's SSDI. First kind of subtraction is known as impairment-related work expenses. These are items, services, or equipment that a person pays for that are needed for work at least partly for work, although they could be needed for other purposes as well, needed for work because of their disability or another condition that's being treated by a healthcare provider, and that they pay for out of pocket and they're not reimbursed for. So examples might be assistive technology, attendance services, medical needs, prescription drug copays, hearing aids, therapy, home modifications, etc. Items that are needed due to the disability or a medical condition that are needed at least partly for work. So those can be deducted from the net earnings from self-employment when figuring out how much of the earnings count against the person's SSDI. Second kind of subtraction is called unincurred business expenses. This one sounds a little too good to be true, but it is true. An unincurred business expense is a regular business expense that would be allowed by the IRS, but that the self-employed person does not pay for themselves. Someone else pays for it. That could be the state VR agency, another agency, a family member, etc. For Social Security disability insurance, SSDI purposes, the person can still deduct those business expenses even though someone else paid for them. Now, the IRS won't allow them to deduct those business expenses that someone else paid for tax purposes, though. That would be considered tax fraud, but they can deduct them for SSDI purposes. And then finally, the value of any unpaid help that the person receives with their business. So for example, if a person's sister were to provide them with some assistance with the business, the value of that unpaid help, if the sister's not charging them, can be deducted as well. And you'd figure out the value of that unpaid help by taking the number of hours and multiplying that by a fair market wage if the sister were actually to be paid for that type of work. So each of those three deductions can reduce the amount of net earnings from self-employment that Social Security will count against the SSDI benefit. Now, after the deductions, if the difference, what's left over, known as the countable income, is below an amount called substantial gainful activity, or SGA for short, then the worker can almost always keep their SSDI benefit. And that substantial gainful activity, or SGA amount, in 2021 is $1,310 a month for a person who's not blind, and $2,190 a month for a worker who is blind, meets Social Security's definition of blindness. Social Security's definition of blindness, by the way, is the vision in your better eye with correction is no better than 20/200, or your field of vision is no greater than 20 degrees. So note that a person's net earnings from self-employment could be higher than these amounts, but if they have enough deductions from their net earnings to keep the difference after deductions below $1,310 a month, or $2,190 a month if they're blind, then they will not be doing substantial gainful activity and can keep their SSDI. Now, suppose that even after the deductions, a person's self-employment earnings, the countable portion, are still greater than the SGA dollar amounts. What happens then? Well, then their SSDI benefit may stop, although there are some months that are exceptions when earnings will not cause SSDI to stop, even if they're above the SGA level. The WIPA project can provide more information about that. But suppose that the person's SSDI does eventually stop due to their earnings. There are safety nets, work incentives that will protect their Medicare, let them keep Medicare indefinitely as long as they remain medically disabled. And there are other work incentives that will let the person get SSDI back without having to reapply a lot more quickly and easily than reapplying if something happens to their business later. If their earnings later drop low enough below SGA, or if they stop working. So great protections. Even if you work your way off SSDI through self-employment, you can still keep your Medicare indefinitely, and you can get your SSDI back more quickly and easily than reapplying if anything happens to your earnings later. Okay, now let's talk about the impact of self-employment earnings on SSI. So for SSI purposes, workers can only deduct impairment-related work expenses from their net earnings from self-employment and not the unincurred business expenses or unpaid help. So unincurred business expenses and unpaid help can only be deducted from self-employment income for workers who get SSDI. Workers who get SSI can subtract the impairment-related work expenses, those disability-related expenses needed for work that the worker pays for, but they can also deduct some other things. If the worker meets Social Security's definition of blindness, then they can deduct almost all work-related expenses. And those are known as blind work expenses. And those would even be work-related expenses that are not related to blindness, but are incurred by a blind worker. So after those deductions, SSI will generally be reduced by a little less than half of the net earnings from self-employment. So if a person doesn't use any impairment-related work expenses, and they're not blind and don't use blind work expenses, then their SSI will be reduced by a little less than half of their net earnings from self-employment. As a result, they come out ahead. Their income from their self-employment earnings goes up substantially, and their SSI is only reduced a little, by less than half of their net earnings from self-employment. So their income from the net earnings goes up much higher than their SSI is reduced, so they come out ahead. And if they have impairment-related work expenses or blind work expenses that they can deduct from their self-employment income, then their SSI will be reduced by even less. Now, if a worker earns enough that their SSI is reduced to zero, there are work incentives that will protect their Medicaid. Medicaid is the medical benefit that accompanies SSI, just as Medicare accompanies SSDI. In most states, a person is automatically eligible for Medicaid if they receive any amount of SSI. In some states, they have to apply for Medicaid separately from SSI, but generally people eligible for SSI, even in those states, will also be eligible for Medicaid. So along with SSI, you get Medicaid. If you work your way off SSI, there are protections to let you keep your Medicaid anyway, even without any SSI payments. And there are protections that let you go right back on SSI payments without having to reapply if your earnings later drop or stop. So these are similar to the work incentives we talked about for SSDI. If you've worked your way off your cash benefit, in this case SSI, you can still keep your medical benefit indefinitely, your Medicaid. And if something happens to your earnings later, if they drop low enough where you stop working, you can get your SSI back quickly and easily without having to reapply. Now, the SSI program, which is a need-based benefit, has a limit not only on income, but also on resources or assets. And that limit for an unmarried individual is $2,000. Luckily, not all assets count against that limit. And if a person's business is a sole proprietorship or a simple partnership, and this would also apply to gig workers and private contractors who don't have formal business structures, then Social Security will not count as a resource what are known as property essential to self-support, or PES. And PES would be items, property that is used for a business. So it could be business equipment, inventory, buildings, etc., tangible things. And it can even be liquid assets of the business. In particular, a business bank account would not count against that $2,000 limit, which is very helpful. Now, on the other hand, if the business is structured as a limited liability company, an LLC, or as an S corporation or a C corporation, then business property does count as a resource against that $2,000 limit. So for people getting SSI who are self-employed and have business property and or business bank accounts, it may be helpful for them to structure their business as a sole proprietorship or a simple partnership rather than an LLC or a corporation, so they can take advantage of that property essential to self-support rule, have higher resources or assets in the business, and still keep their SSI. Now, there is a terrific work incentive that can be used by self-employed people, either people who receive SSDI or people who receive SSI and have other income, such as self-employment earnings. And that work incentive is called PASS. That stands for Plan to Achieve Self-Support. It's a work incentive that lets a person choose a work goal, such as full-time employment or starting a business. And it enables the worker to receive SSI payments or higher SSI payments to offset out-of-pocket expenses they need to pay for business startup. So a PASS can be used, again, by someone who receives SSDI, even if they haven't started getting self-employment income yet, or a person receiving SSI if they have other income in addition to SSI, such as self-employment earnings. Now, if the worker starts out with only SSDI, they're not receiving any SSI, the PASS would help them qualify for SSI payments. That means they'd actually be getting two payments from Social Security at the same time, SSDI and SSI. If the worker starts out with SSI payments and they have other income, such as self-employment earnings, that would ordinarily reduce their SSI, they can use the PASS to keep more of their SSI up to the maximum. And then that extra SSI income they receive helps to offset the out-of-pocket expenses they pay for business startup costs. So a pass can be one helpful way to fund startup costs for a business. Certainly there are other ways as well, such as grants from the state VR agency, small business loans, and others. But a pass that's used for self-employment can last up to 18 months and can last longer if necessary. But it has to be approved by Social Security by a pass specialist, a member of what's known as a pass cadre. And benefits planners, who can be connected through the Ticket to Work helpline that I mentioned in an earlier slide, can help a person write a pass and negotiate with Social Security to get it approved. So a pass can be part of a braided funding strategy to pay for business startup costs. A pass can also be used for an employment goal or for telecommuting. And thank you very much for participating in this training.